Finally, the Indian corporate bond market is coming of age. And in this podcast, I'm going to talk to you about three main aspects of this Indian coming of age. The first is, why am I saying that Indian corporate bond market is coming of age? The second is, when any market comes of age, there are new opportunities, new players, new product, new systems, especially in the digital space, and thus everything gets new stakeholders. So many new players and factors emerge, and this is the biggest opportunity for a whole ecosystem to develop. And obviously the threats are there, and threats are clearly in many forms. One is clearly the old players, established players are will see the way their old practices are being sidelined by the new opportunities and the new players coming through. And other risks that can emerge from this changing marketplace of the Indian corporate bonds. So just brace yourself. It could be a longer podcast, and but let me assure you that this can be an eye opener for those of you, and I would suspect it's many of you who keep watching the corporate bond market but are not very conversant with the intricacies of the market and how the whole market is clearly unfolding for the new opportunities that can emerge. I'm Arjun Patsarthi, founder inrbonds.com. Just to give you credentials of why you should listen to me, I have been a very active player in this market over the last 20 years in various forms. I was a trader, a corporate bond trader, what do you call a credit trader for banks. I was also a fixed income fund manager for mutual funds. Then the last 10 years, I have been doing research and educating the whole market participation and financial service professionals, investors in corporate bonds through our online platform, INR Bonds. And in the last 2 years, we have launched our electronic bond platform, which is again clearly embracing the opportunities that is coming through with the Indian corporate bond market coming of age. So let me get down to the first point. The first is, why am I saying the Indian corporate bond market is coming of age? Now I'll give you a bit of history. So in the last 20 years, we have seen most of the markets come of age. As in come of age, when I mean come of age, that means they have been embraced electronically, and the old systems and practices vanished. The new systems have given rise to much more efficient markets. So if you take equity markets, clearly they are way ahead with institutional and retail participation in full. And this is largely through the fact that all equity trades are fully electronic, seamless settlement, and most importantly, price discovery is very good and very quick and efficient. And investors can get liquidity, that is, they can get a very cheap, a better, very easy price, and they don't really need to uh, uh, take too much of effort to invest and transact in equities. Similarly, government bonds, which was pretty inefficient just before RBI made it fully electronic through the Clearing Corporation of India, and price discovery was very poor. There was a huge information arbitrage happening, and uh, all those bad practices that come out of lack of information arbitrage, where few people make most of the money at the cost of investors. And RBI completely turned this around, made it fully electronic, and Indian government bond market is now fully electronic with 95% of the trades being electronic. Like anybody can see live prices in the market. It's largely institutional, and RBI has now made it easy for retail investors to access the government bond market. And what this clearly has done is enable governments and state governments to borrow effectively at the best prices available in the market, provide liquidity to investors, and after a long, long while, because of this efficiency of this market, the Indian GSEC government bond market is getting to be included in global bond indices. It's taken a long time. There's still just a last mile to go, but it's come so far and it's become one of the most efficient markets in the world. And if you take other markets, including commodities, which has been a very opaque market for a long period of time, that has gone completely electronic. Both retail and institutional participants are present in this market. Then you have even the very most opaque of markets, which is the real estate market. Now that has gone completely online, at least for the price discovery process. So any new customer who wants to either rent or buy a place first goes to platforms like Magic Bricks, 99 Acres, or nobroker.com, etc. Checks the prices, and even though ultimately it's the brokers who have been doing the transactions for them because of the intricacies of the real estate market. But the fact is, price discovery is very, very smooth and efficient. And also, the access for customers to real estate has become much easier through these platforms. However, corporate bonds, now which show supposed to be one of the most important markets in the world, and it is the most important market in the world. It actually brought down the global economies in 2008. Has been given a stepmotherly treatment. Now, various reasons, but at the same time, despite the stepmotherly treatment, the market has grown considerably. In the last 10 years, corporate bond outstanding has grown from rupees 10 lakh crores to rupees 40 lakh crores, 15% CAGR. Similarly, mutual fund who pool assets to invest in fixed income, the fixed income assets have grown again 15% over the last 10 years on a CAGR basis, which clearly shows, and they are now one third of the corporate bond market, which clearly shows that there is a huge need for the corporate bond market coming of age. Now, again, going back to what I'm saying, why am I saying corporate bond market is coming of age? Now, in the last 20 years, when all other markets have gone fully electronic, and then you have a couple of very, very unique features that fintechs have taken over, which is the payment systems, largely driven by the UPI, and that was driven by the government of India and the RBI. The payment is now fully digital process. It's the most efficient payment system in the world in India, accessible to every single person in the country through a electronic means. And similarly, if you take in the lending space, fintechs have really taken the loans to the consumer directly. They have been the face of improving the distribution of loans from banks to a wide variety of borrowers, which is again de-risking banks' portfolios. Banks have clearly struggled over the last 10 years when all the loan turns sour, and the government had to spend huge amount of money to capitalize banks. And it is very clearly that fintechs have embraced this move by the government to de-risk banks, and they have taken the banks to a wide variety of borrowers through a digital experience. In all this, corporate bond market has remained 20 years behind in time. Why? And clearly because I think it's been though there have been huge amount of talk of why Indian corporate bond market needs to develop for the economy to grow to $5 trillion in the next by 25. There's so much of money need to spend on infrastructure. Rupees 1 trillion is the outlay of the government. And with all this, why India is lagging behind the rest of the world in the development of its corporate bond market. For various reasons, I will not go too much into this, but what clearly what has been the case so far is like this. The corporate bond market has not been able to throw out live prices to investors. This is the institutional market, which is almost over 95% of the total corporate bond market. And why has the live prices not been thrown out to investors? And clearly, you have live prices being thrown to in equities, commodities, government bonds, even real estate. And even more important, which is a very surprising thing, retail investors have access to live prices through electronic corporate bond platforms, which now SEBI has recognized and is looking and is regulating, and will come out with regulations in the next very few weeks. They already passed the regulations in the board meeting in September. But the institutional corporate bond market, there are no live prices. To be fair, SEBI has tried to provide online quotes to making institutions forcibly trade on the RFQ platforms of the stock exchanges of BSE and NSE. But unfortunately, this has not been able to throw live prices purely because even though they have been forced to put their trades on the platform, most of them are brokered offline and put it online on the RFQ platforms. This is the feedback which we are getting from the market participants, and clearly, if that's something that needs to be addressed by the regulator. So, without a lack of live prices, the inefficiency in the corporate bond market is very apparent, and clearly that's led to the underdevelopment of corporate bond market for the last 20 years or so. But that is being addressed now. And how am I saying it's being addressed? One is that SEBI is now the Securities Exchange Board of India, who regulates the corporate bond market, is aware of the whole scenario in the institutional corporate bond space, and is very clearly working towards a system which will make corporate bond market for institutions throughout live prices. And clearly, if once this happens, then the corporate bond market for institutions can become as simple and easy to transact as the GSEC market. Now, the first sound bites came from RBI when they talking about corporate bond repos. This is a very technical term if you are not a market participant, but it's just a case in point. RBI pointed out that the repo in corporate bonds, repo is basically to provide funds to investors so that they can buy corporate bonds, or if they have hold corporate bonds, they can borrow the money against the bonds for a shorter period of time through the institutional market. And the GSEC repo market is very, very active. It is the most active market, and clearly very efficient. But corporate bonds have not really taken off in terms of repo, largely because of an infrastructure problem, which again which is existing. The infrastructure is there in the which is through the Clearing Corporation of India, which is doing for the government bonds, but now it's going to be taken to the corporate bonds as well. So SEBI is definitely working towards that, and clearly once that happens, then it's a matter of time before they make the whole uh, process of corporate bond transactions similar to government bonds through a centralized settlement agency like CCIL. Again, a bit technical. I'm not going to go too much into details. Those of you who want to, know more about this, welcome to look at our INR bonds research, inrbonds.com. We have been putting out research on bond markets for the last 10 years now. A huge amount of research notes available for you to check out and discuss. And so that is the first. We should be able to expect live prices on corporate bonds. The second is that given that the need for the issuers, that is borrowers, especially the corporate borrowers, to broad base their liabilities. As in, when I'm saying broad based liabilities, till now, most of the corporate borrowers, if they want to raise money through corporate bonds, they'll go and ask an arranger who will then go and place it with some 50 institutions. So this has been denied access to retail investors. And clearly, but the what has happened is that it exposes the issuer to the fact of that many of the institutional investors may not be able to reinvest in the same issuer because the institutional investments depend on a lot of factors. And in times of stress, like we have seen in 2008 global financial crisis, 2020, 13, 14, when there was an issue with the Fed tapering tantrums and the INR depreciated. And even now, when there is a huge amount of pressure on global liquidity and domestic liquidity, with the rupee falling sharply, uh, the institutions clearly tend to become very risk averse and do not want to lend more to issuers. Issuers then struggle to find liquidity, and when they struggle to find liquidity, many of them see their borrowing costs go sharply higher, and it makes the business unviable. And many of them tend to either default or close, or and this causes a huge amount of problems to investors. So in this case, clearly the way to broad base the liabilities of the issuer is through issuing bonds to retail investors. And retail investors are like what's the bank called CASA, which is current account and savings account. And why do they talk about a current account and savings account deposits? Largely because they see it as sticky money. And with the sticky money, the risk of the issuer facing liquidity crisis falls. Retail investors are more steady, and the more they can get access to such issuers, then the better it's for both the retail investors as well as the issuers. And retail investors have also typically been underexposed to corporate bonds, to the bond market itself, but more towards, but to a very large extent, they have been denied access to corporate bonds, largely because of the fact that the corporate bond market was still way behind most of the other markets in terms of going electronic. But now with electronic bond platforms, there are many, including INR bonds, throwing out live prices, live bids and offers for retail investors are able to judge the transparency in prices, are able to access the markets through electronic platforms, and more information is now available to them. And they are able to access corporate bonds through electronic bond platforms, which was not available to them earlier. And in this, that's one of the reasons why SEBI has recognized the importance of electronic bond platforms, corporate bond platforms, and are regulating them. And this is a very important step towards enabling the smoothest and efficient functioning of the whole corporate bond market. Because once they pass regulations on electronic bond platforms, then many fintechs will come in and make even institutional bond trading more efficient through platforms, with SEBI providing the settlement infrastructure. So this has taken 20 years and lots of noise, lots of issues, but then finally, I think the whole the corporate bond market is opening up, and clearly there are more issuers accessing the market and more players coming in, especially on the digital space. More investors are investing in startups that are focusing on the corporate bond market, and these include very large private equity investors for very large fintech platforms. And clearly, with this opening up of the corporate bond markets and the coming of age, issuers, there will be more issuers coming to the corporate bond market to raise money. and they will have better pricing for their issues. They will have more liquidity for their issues, and they'll have a broader base of investors for their issues. And with all this put together, it's definitely a win-win for both the issuers, the investors, and the regulators, and the economy, and the government, and the whole market ecosystem. So this is the reason why I have said that Indian corporate bond market is coming of age. Now, let me go to the second factor. What are the opportunities here? So clearly, the opportunities are wide open. The first is that the market is going from a non-electronic market to electronic market. So this is an opportunity for fintechs, and fintechs can come in many spaces here. One is on the infrastructure side, which is providing settlement soft solutions to the regulators and to the exchanges, so that settlement is seamless. Providing trading systems, again, which is again going to make price discovery live price throughout live prices. And throwing out live prices, the market becomes efficient. Price discovery is very, very strong, and more players will come in, widen the market, deepen the market, and have more liquidity to the market. And then even in other spaces, in terms of valuations, in terms of reporting, in terms of tools, trading tools, in terms of so many other payment systems towards making the payments more efficient, and geographical making geographical reach easy, enabling foreign investors to invest in corporate bonds here seamlessly. So this is a whole infrastructure process where fintechs can work very, very closely with regulators and make the market fully electronic, more efficient, and clearly give everyone a very unique and very strong, growing, and very large opportunity. The second is obviously the customer acquisition front, where the fintechs will play the biggest part here. So traditional distribution of corporate bonds will go through the platforms. More investors will be able to access corporate bonds, largely because they can compare and prices. They can see the extreme transparency in what they are investing in, get more information, and have have access to a very large universe of bonds through various platforms, and give a wider solution to investors and the financial advisory community for investments in corporate bonds, largely through the fact that uh, depending on the risk of the investor, similar to equities, an investor who's risk averse to invest in very strong, fundamentally good companies, while investors who are more aggressive in risk can take in stocks that can potentially deliver very high returns but carry also higher risk. So similarly in this space, investors with look for safety and lower returns will get their full fill, and investors looking for higher returns but are able to want to take higher risk can get their fill as well. And clearly, with the platforms now, equities, investors can invest in equities, global equities, through equity platforms. Investors should be able to invest in bonds right from US treasuries to very strong corporate bonds, or even junk bonds if they want to, global bonds in USD terms, providing a hedge against the currency depreciation, as well as earn higher returns when possible. And the whole platforms, and the platforms clearly are will draw in investors, both domestic and global, into the corporate bond market. Again, making it very much more efficient in terms of transmission of prices and liquidity. And when markets become efficient, they tend to grow, and they tend to grow very fast, and which again can fulfill the government's needs for raising their funds, broad basing their uh, uh, borrowing for the infrastructure, For example, governments need a huge amount of money for infrastructure projects, and they are going through the InvIT route. Again, I'm not going to go too deep into the InvIT route. What is the InvITs, etc. InvITs rates, more products like this will come out. And when more products like this will come out from very strong sectors, especially driven by the government, and provides more savings opportunities to investors. And the government gets its money instead of going to the budget or the taxpayer to fund the infrastructure bill and the growth bill as well. And the private sector and the banks too can de-risk their portfolios by issuers when issuers go to the bond market to raise funds rather than only taking big loans from banks. And banks can also be more efficient in their use of capital and leverage. So here clearly the opportunities are there. Again, a whole ecosystem can emerge in terms of custodians, in terms of again retail settlements, in terms of payments, in terms of obviously trading, in terms of trading systems, tools, etc. Um, so the whole ecosystem can emerge. New players can come in, new products can be launched, more issuers can come into the market. So the opportunity here is very, very clear, at least on the retail side. When the market opens up for retail to bond platforms, is that the market tends to widen for a whole host of borrowers, and with new invest and a huge number of new customers coming in to invest in corporate bonds. The opportunities are again very clear. So now just let me just come down to the threats. So the threats are again clearly in the form of whenever a market is coming of age, there are threats. First threat is towards the incumbent, where traditional businesses see that the business model is not coming through very well. What was earning money for them 10 years back is no longer earning money. Even if it's earning money, there is zero growth or falling growth. And when all that is happening, then the traditional businesses either fall by the wayside or they tend to adopt to the new opportunities. And so clearly, the good business that has strong growth strategies will move into the new opportunities that is present. The second threat is that yeah, when new markets are coming of age, there could be practices that can be inefficient, that can provide uh, uh, a few firms who try to make more money from through various other practices. Especially, we have seen that happening in both equities and um, other products as well, where huge amount of practices, including the lending space, where a huge amount of practices of the industry are questionable, especially through the digital route. So clearly, there could be more risk in this kind of when the markets are coming of age. But that risk is handled well. The regulators are on the ball, and if they keep taking in some feedback from good market participants, that should be a problem that should not be difficult to handle. So clearly there are threats, but threats can be handled. In the market, the participants, who are taking the opportunities, this is present in the corporate bond market, can clearly work with the regulators and the policymakers to make sure that the market is functioning smoothly and efficiently and serves its purpose. So that's where the threats are, and clearly we have seen most of the markets who have gone through an evolution process where the opportunities are more and the threats, while there, are able to take care of itself. And with regulation, with the regulators now looking to regulate all platforms, where after the experience with cryptos, now and are now clearly able to focus on what could be the threats that can come through with and they can make regulations accordingly. Okay, so this is the main theme of this podcast, where the Indian corporate bond market is coming of age, and the opportunities are enormous. There are threats, but that can be handled by a very strong partnership process between the industry, between the new players taking advantage of the opportunities, and the regulators and the policymakers. Thank you very much for listening in, and do reach out to me through, you can always check inrbonds.com and comment, and you can contact us if you want any more information on this. If you have any queries or if you have any comments to pass on this podcast.